the most famous bankruptcy in modern history, paid its London creditors back. In full. That took 17 years. This is the first night of it. 2 in the morning, a 158-year-old bank filing for bankruptcy. 6 months earlier, the same government had rescued a different bank. The day after this filing, it rescued an insurance company for $85 billion. Same crisis, same officials. Opposite answers 1 day apart. Nobody went to prison. I am Archie. I keep the files nobody wants reopened. This one is stamped file number 9, Lehman Brothers. Inside, 1 weekend, 3 decisions, and a 2,200-page report that produced no charges at all. Nobody in here has a conviction. Open it with me. The file starts at the end. Wind it back. Further than you think, the color comes back with it. This firm had been open for 158 years. 158 years. That is older than the telephone, older than the light bulb, older than the Federal Reserve that would spend that weekend deciding what to do about it. On Wall Street, age works like armor. It says you have already survived worse than today. Now, March 2008, 6 months before that night. A smaller investment bank runs out of cash. Bear Stearns. Watch what happened, because most people remember it wrong. Bear Stearns did not go bankrupt. The Federal Reserve helped arrange a sale to JP Morgan and put public support behind the deal. The firm did not die. It got a buyer, and the buyer got help. Everyone on Wall Street read the same sentence off that rescue. If you are big enough and tangled up with enough other people, somebody catches you. That belief is not a rumor, it is a price. It sits inside how long a bank's lenders are willing to wait before they ask for their money back. For 6 months in 2008, some of the largest firms in America were partly priced on a promise nobody had actually made. Nobody had written that promise down. Nobody had said it out loud. The rule simply kept working, so nobody tested it. Spring passed, summer passed. The rule held for 180 days. Then a weekend came, and it stopped being true. 2,200 pages. That is the length of the report a bankruptcy court's own examiner wrote about this firm. His name is Anton Valukas. It landed in 2010, more than a year after the doors shut. An examiner is not a prosecutor. A bankruptcy court appoints him to walk through the wreck and write down what he finds. He can accuse nobody. He can convict nobody. He writes. What he wrote about was an accounting technique the firm used, called Repo 105. Here is the shape of it, as the report describes it. The technique let the firm hand assets out just before the end of a reporting period and use the cash to pay down what it owed. A few days later, it took both back. The picture the public saw on reporting day was tidier than the picture on the days either side of it. That is the whole idea, not a secret vault, a calendar. Why does that matter? Because the number people use to judge a bank is how much it owes against what it holds. Fewer assets, less owed for 1 day. The number improves without anything else changing. Now read the next part slowly, because nearly everyone gets it wrong. The examiner wrote that there were, his phrase, colorable claims. A colorable claim is one a court could reasonably be asked to hear. It is a lawyer's assessment that a case could be brought. It is not a finding of guilt, and it is not a verdict. No court has ever ruled that this firm committed fraud. 2,200 pages, about 4 long novels, more than a year of work, and the legal force of a suggestion. The auditor on the accounts was Ernst & Young. In 2015, the auditor settled with the New York Attorney General for $10 million and separately paid $99 million to investors. The state's case was the first ever brought against one of the Big Four accounting firms under New York's Martin Act. A securities law with unusually long arms. A settlement ends a case. It does not decide one. No criminal charge was ever filed against the auditor either. Now hold all of that in your head and check the date on it. Every page of it was written afterwards. In September 2008, nobody in Washington had read a word of it because none of it existed yet. The people who decided that weekend did not decide on this. Monday, the 15th of September 2008, 2 in the morning. Lehman Brothers filed for bankruptcy protection. No arranged buyer, no public support behind the deal. The March rule did not apply. Nobody had ever written it down, so nobody could point to the moment it was withdrawn. The next day, Tuesday the 16th, the government rescued the insurance company AIG. $85 billion. Read that again, 1 day apart. Same crisis, same officials, opposite answers. Why? This is where a lesser file would guess. I won't. The people who made that call, the Treasury Secretary, the Chairman of the Federal Reserve, the head of the New York Fed, are all still alive. So here is the answer the government gave in public a year later. In a speech in August 2009, the Chairman of the Federal Reserve said this: "The company's available collateral fell well short of the amount needed to secure a Federal Reserve loan of sufficient size to meet its funding needs. The Federal Reserve," he said, "cannot make a loan without collateral, and the government as a whole had no legal power to take the firm over or to put money into it." So the failure was, in his words, unfortunately unavoidable. One later academic study challenged that account, arguing the collateral was there. All three men later wrote books and answered to Congress, and their accounts do not line up neatly. What nobody disputes is the sequence. Bear Stearns caught. Lehman not. AIG caught. Now the part that happened while the building was still warm. 2 days after the filing, Barclays bought the North American investment banking business. The price was $1.75 billion. $250 million of that was cash. The other $1.5 billion was the New York headquarters and 2 data centers, a skyscraper and some server rooms. The support put behind the insurer the day before was 48 times that number. A sale like that is not just property. The desks stayed, and the business at those desks carried on under a new owner. What changed was the name on the front. People said at the time that the buyer had taken the best parts and left the rest. So the Lehman estate, the team whose whole job is to claw money back for creditors, sued Barclays in 2009. The claim, an $8.2 billion windfall. Profit, they said, the buyer never paid for. In February 2011, the bankruptcy court ruled for Barclays. The estate lost. The judge, Judge Peck, wrote that the sale process may have been imperfect, his word, but that it had reduced the risk to the wider system. So, not a raid, a rushed, legal, court-approved sale that a court was later asked to undo and refused to. Count the survivors. The auditor is still one of the largest accounting firms on earth. The buyer is still trading. The firm in the middle no longer exists. That is the end of the collapse. It is not the end of the file. The creditors were only getting started. Nobody from Lehman Brothers was criminally charged, not one executive. Set that beside the last great American financial wreck. After the savings and loan collapse of the 1980s, prosecutors charged more than 1,100 people. After this one, from this firm zero, Richard Fuld, the last chief executive, settled a shareholder case for $90 million. Every cent of it was paid by the company's insurance, none of it from his own pocket, and with no admission of wrongdoing. He settled a separate claim from the state of New Jersey, alongside 16 other defendants, for $8.25 million. He has never been charged with a crime. And then the ending nobody expects. In London, Lehman's European arm went into administration, the British term for a controlled wind-down. It took 17 years, it finished in 2025. Every creditor of that London estate was paid in full, not cents on the dollar, all of it, the principal plus statutory interest at 8% a year for all 17 years. And there was money left over after that, which went back to that estate's shareholders. Now cross the Atlantic. In New York, the creditors of the company that actually filed got far less. According to the estate's own filings, its main class of creditors ended up with about 46 cents on the dollar. The shareholders got nothing at all. In December 2011, a court cancelled their shares outright. On the numbers alone, the London creditors finally lost nothing at all. That is one estate, and it is not the whole story. London, everything. New York, less than half and then zero. Here is the lesson from file number 9. The bank was the same bank on Friday as it was on Monday. What changed was how long anyone would give it. Given 17 years, London's assets covered everything owed and more. Given one weekend, nobody would wait at all. That gap between what a thing is worth and what you can prove it is worth by Monday morning is where panics live. It is also where 3 decisions got made in 6 months, and only one of them went the other way. Ask anyone who carried a box out of that lobby at 2 in the morning how that reads. Close the file. The next one I opened was audited too, every year. Signed off, right up to the week it stopped existing. I'll keep the light on.